Ever thought about how a company actually accounts for a promise? I mean, it sounds a little abstract, right? But today we're diving into exactly that. How businesses handle all these uncertain future obligations, from something as simple as a product warranty all the way up to a massive multi-million-dollar lease.
Okay, so what could a potential lawsuit and the warranty on your new laptop possibly have in common? They seem like they're from completely different planets. But in the world of accounting, they share one absolutely crucial thing: uncertainty. They both represent a potential future cost that a company has to think about and sometimes has to account for right now.
So how on earth do businesses deal with this whole sea of what-ifs? Well, they don't just guess. No, they rely on a really powerful accounting concept that helps bring some order to all that chaos.
And that concept has a name: contingency. It's the official term accountants use for any situation where a potential gain or a potential loss all depends on some future event. You can kind of think of it like a financial cliffhanger.
So the very first step when you're facing one of these contingencies is to figure out how likely it is to happen. Accountants basically become odds makers, and they use this three-point scale. Is the event probable, meaning it's almost certainly going to happen? Is it reasonably possible, so more than a slight chance but not a sure thing? Or is it remote, like a real long shot?
But here's the real kicker. A company can't just go around recording every single potential problem. To actually put it on the books, to accrue it, as they say, two things have to be true. The loss has to be probable, and you have to be able to reasonably estimate the cost. That is a very high bar to clear.
All right, let's make this real with something we've all dealt with: product warranties. We see them all the time, but from an accountant's point of view, there's a lot more going on. In fact, there are two totally different kinds.
So on one side, you've got your assurance-type warranty. That's the standard one that just comes with your new phone or whatever. Accountants see that as just part of the cost of making the sale. But then you have the service-type warranty. That's the extended one you pay extra for. That's treated as a completely separate thing you're buying, a service.
And here is where it all clicks. That standard warranty, it's a textbook loss contingency. The company knows from years of experience that a certain percentage of their products will probably need repairs, and they can estimate that cost. That's why they have to record it as a liability right from the very beginning.
So when you see a number like this, $22,000, that represents the company's lingering promise. It's not cash they have sitting around. It's a liability, an obligation on their books. It's their best guess of what it'll cost to fix the products they've already sold.
Okay, so let's scale up from something like a warranty to another huge corporate promise: leases. When a company signs a really long-term lease for, say, a headquarters building or a whole fleet of trucks, accountants have to answer a really critical question.
And that question at its heart is this: are we just renting this thing for a long time, or is this basically a disguised purchase? Because the answer to that question completely changes how the lease gets recorded.
To get to that answer, accountants run through a series of tests. They're looking for clues that this lease is really more like buying than renting. Like if the lease is for most of the asset's useful life, or if the payments basically add up to the asset's full price tag. If it trips any of these wires, it's called a finance lease. If not, it's an operating lease.
And here's where things got a huge shakeup. See, in the past, a lot of those operating leases were sort of hidden away in the footnotes of the financial statements. But a big rule change brought them all out into the open. Now, all long-term leases, finance or operating, have to show up on the main balance sheet as both an asset and a liability.
So you might be thinking, okay, if both types of leases are on the balance sheet now, what's really the difference? Well, the big distinction is in how they affect the income statement and the cash flow statement as time goes on.
For an operating lease, the accounting is pretty straightforward. The company just bundles everything together, the interest part, the principal part, and calls it one single line item: lease expense. It keeps things really simple and clean.
This table really lays out the whole story. A finance lease gets treated just like a loan. You see separate expenses for interest and for the asset's depreciation. An operating lease is treated more like rent, with just that one single expense. And that difference also changes how it looks on the cash flow statement, which can really give investors a different vibe about the company's finances.
So after all that, what's the big idea here? Why all these detailed rules and different treatments? Well, it all comes down to one really simple but incredibly powerful idea.
The whole goal is to give investors a crystal clear view of a company's real obligations. It's about transparency. No more hiding huge risks and massive promises in the fine print.
By forcing companies to put these things right there on the balance sheet, the rules give all of us a much more honest picture of what's going on.
So the next time you're looking at a company's financial report, don't just stop at the big, flashy numbers. Dig a little deeper. Ask yourself about their warranty liabilities. Look closely at their lease obligations. Because now you know what to look for. You know how to find those hidden promises that can truly make or break a business.